So time to move on now to the panel discussion, which will cover the growth of self-insurance in Asia and intersection of industry and regulatory demands. This session, ladies and gentlemen, will be moderated by Mr. Malcolm Cutts-Watson. He's the Managing Director of Cutts-Watson Consulting Limited. With 4 decades in the alternative risk industry, Malcolm has gained a unique insight into captives and a sophisticated outlook for the future. He's a member of the Labuan Financial Services Authority International Advisory Panel. He has advised many Asian corporates and governments on captive strategy and spent time in China fostering the use of captives. Joining him on stage will be members of the panel, Mr. George McGhie, the Managing Director of Captive Practices, Willis Towers Watsons, Richard Cutcher, Editor, Captive Review, and Syahrul Imran Mahadzir, the Director, Market Development, Labuan Financial Services Authority. We welcome the moderator, members of the panel, to the stage.
Yes, we can.
Excellent. Okay. Well, thank you very much for the introduction by the MC. We're here to talk about the growth of insurance, thank you, self-insurance in Asia, an intersection of industry and regulatory demands. And to help me explore this, I'm very pleased to have the panel. The MC did an excellent job of introducing them, but I think what we bring is different perspectives. From George, we have a market practitioner's perspective. From Syahrul, we have obviously a regulator's perspective. And with Richard, we have, I think, an industry commentator's perspective. So I think we'll be able to cover all areas. My role really here is to try and keep order on these three. So first of all, I think we need to validate the proposition in the title, and then we can explore the implication and some of the likely outcomes of this intersection, and I suppose I would call it tension. First of all, though, I think we just need to define what we mean by self-insurance. So I'd like to try the polling technology and just put up a question for the audience. Okay, so really it's to gauge your views on what do you regard as self-insurance. So if you'd like to use the technology and start filling in the questions, we'll see what the audience thinks in terms of what is self-insurance. Sorry. No,
I think we got the wrong first question.
Yeah, sorry, you picked up the wrong question. This is one that we're going to have later on.
I mean, just disruptive technology at its best, I think. There we go.
Here we are, yeah. So this is really an opener for you. When we talk about self-insurance, what do you think it refers to? And I'm very pleased to see at the moment, don't know is 0. So that's always good news. Okay. I think, I mean, the answer is what I was hoping we'd get to, which really self-insurance is a variety of techniques. It doesn't have to be captives, but clearly captives are a key part of that. And a definition of self-insurance often is a management technique in which a company sets aside a pool of money to be used to remedy a loss. So clearly captives fall within that, but I think it's important to remember that captives aren't the only form of self-insurance. Okay, so we've defined what self-insurance is, so maybe I can now turn to the panel really and ask them what sort of interest are they seeing in self-insurance in the region. Richard, I know that you prepared an analysis of the Asian self-insurance area last year, and I know that you're trying to update that at the moment. Are there any conclusions you can draw from that?
Yeah, I'll take this slide switcher from you, Malcolm, and hopefully I'll bring up a bit of what we did last year. And I presented the findings. We did a research report last year in advance of this conference, and just to really, really discover some of the bit of what we're asking today, really, on these questions is at what point are we at in kind of the captive insurance market in Asia, and we really had some interesting bits come back, and I'm just going to work out how to move on to the next slide. Here we go. So I'm not going to go through everything we found out last year because we did all that last year, but just to put it all in context, we really asked the question, how well known do you think captives are to the Asian market? And one of the largest things that came back was that the industry seems to believe that it's really only known, or most likely known, by the largest companies in Asia, which is, I think, we probably agree, is how most markets start off their relationship with captives. And then we also asked, another interesting question we asked was, what were the most common factors driving Asian companies to consider forming a captive? And a maturing risk management culture was one of those top drivers. Increased understanding, in-house understanding, of the captive concept was also a big one, and the struggle to find coverage for unique risk portfolios. So if you're struggling to find insurance in the commercial market, that might be a reason a company explores a captive. But to take it forward, to see how some of that translates to numbers and what kind of captive activity we're seeing. If we look at Asian domiciles in the last 3 years, it's quite, I think the word modest growth might be the way to put it. Not bad, but I think modest. I'm sure that our friends in Labuan will be pleased that I think they're leading the way in terms of new formations in the last 3 years. Labuan, Micronesia, and Singapore, kind of the most active domiciles, and all serve slightly different purposes. So we're seeing a little bit of growth, but not huge growth. If you look at that 2017 column, I think that's about 14 new captives in 2017, which isn't a huge number. And if you put that in context of the international market, we'll see that the numbers in the more established domiciles are a lot higher, obviously. So that the largest European jurisdictions, Luxembourg and Guernsey, are quite modest growth in those markets, but then the Caribbean and the US markets, we're still seeing quite large captive growth, and that last column there indicates just the size of those captive markets. So I think, to answer your question, Malcolm, I think we're all quite enthusiastic when we were here a year ago, and particularly if we went back a slide, that's probably borne out in the numbers that Labuan produced. Some quite good formations from Labuan last year. So I think we have seen some of those conversations kind of produce real results.
Okay. So that's the numbers side. I mean, George, in terms of what you're hearing on the ground, you're obviously talking to risk managers, brokers. What are you hearing, and is it talk about just traditional property and casualty risks, or is it, as Oliver's suggesting, maybe we should be looking at different sorts of risks?
Well, I think, I really enjoyed Oliver's presentation. There were some excellent points that came out from that. I also think that as a captive practitioner of 25 years in Asia, I feel pretty bad about the lack of awareness that is evident around the region about captive. And I'll share the blame for that with colleagues from some other captive practitioners and promoters. But there are lots of issues across the region. I mean, one key one being that it is not a single homogenous market. We're looking at an enormously varied and enormous market, and a lot of structural and practical and cultural obstacles to the actual process of forming captives. In terms of self-insurance in its broader sense, there is enormous self-insurance in Asia, as there is around the world, in the form of restrictions on your traditional insurance placements for your traditional risks, whether that's retentions or sublimits or exclusions. Insurance is not a panacea. It doesn't cover all aspects of risk. You buy property insurance, it might be called an all risks property policy. It's not covering all risks for every dollar. So there is enormous retention even on traditional risks. When we then look at the emerging risks, non-traditional risks, business risks, however you define them, as Oliver was saying earlier, those risks exist. They haven't necessarily been fully valued, assessed, and managed, but they're there. And what we are seeing is a great increase in focus from clients on risk as risk, rather than risk in terms of what you can insure. So we have a very wide range, an increasing range of studies on the go for clients across the region. We put a lot of resource into this, as I know other advisors have, to help clients assess and value the risks that they face, whether traditional or non-traditional, and to bring together solutions for non-traditional risks, perhaps combined with solutions for traditional. And that's where captive comes in. To me, a captive gives risk an identity within the parent organization. You have a very wide range of risks arising from all aspects of your operations. You can buy traditional insurance. Generally speaking, as contingent capital, traditional insurance is very cheap. It's a great buy. If it's available, you should be maximizing access to that. But for many risks, as Oliver pointed out, traditional insurance is not available. There may be options in the alternative reinsurance market. To access reinsurance, you need an insurance license. Captive provides insurance license. Alternative risk placements always involve significant retained risk. You need to finance that retained risk in the same way that you're financing retained risk on traditional cover. So we are seeing a great upswell of interest in these areas. We are running a number of studies, as I know many others are. Has it yet transpired in a flow of hundreds of Asian-owned captives? Not quite yet.
Okay. Watch this space.
Well, we've got a few coming through, but yeah.
Okay. So that sort of takes care of the industry perspective. If we can now turn to the regulatory side, and Syahrul, I suppose the question really is what sort of demands are being put on you as a regulator in terms of oversight of captives? And a more general question is, well, why do you need to regulate captives in the first place if they're all they are just self-insurance vehicles?
Thank you, Malcolm. I think it's great to know that the spotlight is on me as perhaps the thorn among the roses here. Right. Okay. The demand for captive or captive licensing, one would say that it is basically just a ticket to operate in a particular market. But actually, in any license that is granted by a regulator to a captive owner, it's basically to provide an assurance that that particular vehicle is being monitored, regulated well within that market, and also in such way that the ecosystem is also there to make sure there's a bit of safety and soundness in how the captive is being managed vis-a-vis the other players in the insurance market. So that's one of the implicit value when an approval is given to a risk owner to establish a captive into the market. On the macro point of view, I think there's also value in terms of how the regulator brings and ensures stability into the market in which the captive operates. So sometimes it can be taken for granted that it is there as a rule, but basically there needs to be a structured market to make sure there's an orderly captive business being underwritten, and up to the point of which that it can provide back the so-called guarantees to its owners in the rainy events of which the objective of the captive is being set up in the first place. So that is something of what I say regulatory implicit value given to any licensing or approval to a risk owner.
Okay, so it's almost a way of enforcing best practice. So that's quite good. So I think that gives a sort of feel for the perspective of the regulator. And I think what we've done now is really validate the opening statements. I suppose if we can now move on to really, what are the implications of this intersection. And at this point, I'd like to open it up to the audience. So if they do want to ask any questions to the panel, if you want to start texting those in. I do have a few prepared questions to fill in any spaces we have. I suppose the first question is, Richard, you look backwards in terms of what's happened with the captive numbers. Would you like to have a guess sort of moving forward what's going to happen? Because overall, I think the total number of captives globally went down. But as we've seen, Asia is underweight at the moment. So do you still think there's likely upside?
I think there's certainly an upside coming out of not just Asia, but other emerging markets. I think Latin America is still chugging along in forming captives. They tend to use the Caribbean jurisdictions. As Malcolm said, we do an annual report where we count captives, and it's not a perfect science, and plenty of people, well, not plenty of people, some people may disagree of how we count captives, but we have our own process and what we include. So, for example, I think Oliver mentioned sales. We don't include individual sales as our captive count. So that 6,500 is plus individual sales, which shows that the number's even higher. And often jurisdictions aren't able or don't want to report the number of sales they have. So there could be another 20,000 captives out there if you want to include sales. As Malcolm said, the number did go down last year. Not by a lot. I think, if my memory serves, I think our report said it went down by about 200 net over the year. But most of those numbers fell out, as we saw from one of the slides, of the more mature domiciles. So what we're seeing is we're not seeing captives being used less by companies, but particularly some in things like merger and acquisition activity at corporate level. If you're a large French cement company and you merge with a large German cement company, you've suddenly got 6 captives on your hands and you don't need 6 captives. So let's turn them into 3 captives, one in Europe, one in Asia, and one in the American market to serve those different risk groups. So we're seeing that kind of activity. We're also, the reason we saw numbers fall, another reason last year, was there's some interesting tax problems or tax controversies in the US market around a particular tax election, which we don't need to talk about, but there's been some court cases where the captive owners have lost, and the tax man has basically said, you're using this purely for tax purposes, and we believe you're abusing its use. So captives are starting to, the smaller captive market in the US, we're seeing some disruption there where those captives are either closing down or being restructured. But the net growth in Asia has, although modest, as I said, has been going up. And I think we will expect to see it going up. Labuan's already licensed 4 new captives this year. I believe Singapore are expecting to license a handful in the next few days, or a couple of weeks maybe. Sorry, George. And Micronesia, we saw a few more captives added in Micronesia in 2017. So in terms of the future, I think it looks good. And as Oliver pointed out, in terms of that GDP number, the GDP, I think, was 30% Asian businesses contribute to global GDP, but only 1% of global captive premium is coming from Asian captives. So there's huge imbalance there and huge opportunities if the jurisdictions here, such as Labuan, want to really embrace it and welcome captives in. I think there is business to be had.
Okay. George, any other comments on that? I mean, are you hearing lots of good news?
Yeah, I mean, I think obviously when we look at, we're talking about self-insurance in general here, and inevitably, because captives are probably the extreme expression of formal self-insurance, you've incorporated and licensed a specific subsidiary to manage your retained risk and to access alternative forms of risk transfer. So it's important to look at that, but because it's the extreme expression, you're not seeing the pipe that's leading to that. So the amount of work that we're doing with clients, just as the part of the broking process, and I know that colleagues in other broking companies would have the same experience, the nature of the broking process now is very different from the way it was even 10 years ago. We're now very focused from the outset of looking at a client's even traditional risk portfolio at the most efficient use of their funds, whether by paying premium to traditional insurers or allocating capital to financing retained risk. And even if you're just retaining a risk on P&L, not formally funding for it through balance sheet even, you're just taking the view that hopefully nothing will happen, but if it does, we'll pay it out of current earnings, you should still be assessing what that means, what the impact of that might be to your business. And really, you should be assigning capital to that. If you're doing that, set up a formal vehicle, license a company, put the capital into that company, formally dedicate it to the financing of properly defined retained risk. So it's building towards that. Whether we'll see the sort of numbers of captives proportionate to GDP that we see in the States or in Europe is a whole different question. There are very different drivers of the captive market. There was a question earlier that came up and then disappeared very quickly about ACE and XL. And actually, Malcolm and I were both in Bermuda when ACE and XL were formed. And ACE was American Casualty Excess, and it was a group captive, a mutual captive, to address the disappearance of casualty capacity in the US insurance market. And XL, which is excess of loss, was set up to provide layers above ACE, again, mutual basis. So the US liability issues are a huge driver for captive use. We don't have those issues across Asia. But when we look at Malaysia, relative to GDP, the take-up of captive in Malaysia is well ahead of the take-up probably anywhere else in Asia. Because of Labuan. Because there's a mid-shore domicile established specifically focused on Malaysian needs that's integrated into the Malaysian insurance and reinsurance industry. And we're starting to see that in China. Edward's here somewhere from our China captive practice, but I think there are 5 or 6, there he is, 5 or 6 Chinese state-owned, enterprise-owned captives. Sorry? 7. Another one. You did another one this morning. And they're enormous companies. I mean, the volumes of premium running through them. And at least one has placed a very advanced alternative risk reinsurance program. Okay. So they've moved very quickly because there was a change in the regulatory environment and a change in the approach. And suddenly, that huge proportion of Asia GDP is opening to captive. So we see those moves, then we may see a big shift. Okay.
We're starting to get some really good questions in now, and I'll try and sort of blend them in with a couple of thoughts I had as well. One question really, which is the other end of what you were just talking about, George, is what's the minimum amount of premium you need in the captive? So if you can give us a quick number on that.
$12.50. I've always said that if I was intelligent enough to be a risk manager, I'd set up a captive. I wouldn't worry about what I'm putting in it. The flexibility it gives you, the options it gives you, the fact that it takes quite a bit of time to set one up, mostly about the internal approval processes, so that if you do face a sudden issue and think, I could really have done with a captive today, but it'll be 6 months before you get one. It costs less than $10,000 to set one up. If you set it up and run it on a fairly light basis, then it'll be well under 100,000 a year to run. Relative to the risk factors that you're dealing with, it's tiny.
So I'd say be prepared, basically, and then be prepared.
Yeah,
have the captive ready.
Yeah. But we'll hear about protected cells tomorrow. Protected cells are another option, another approach that manages with that. So I'm not a great fan of the sort of rule of thumb on premium volumes.
Right. We've got a number of questions really on the sort of practicalities, which we'll come to in a moment. But just to go back to the regulation side, I mean, we've seen a steady flow of increased regulation, I think, since the financial crisis of 2007 across all financial services industries. Insurance hasn't been immune. That's the sort of direction of journey. Is there anything in the pipeline in terms of further regulation?
Okay, I'll try to address on how all these waves begins in the first place. You got it right when you say the financial crisis actually is the impetus for all the onslaught of rules, new regulations that come into the market, right? The earlier appetite of regulators in 2000, 2010, or prior to the global crisis, is more a principle-based approach. So nothing much is being prescribed. Everything is actually on a objective-oriented kind of measures. But that all changed when it comes to the global crisis that you mentioned earlier, where regulators realized that there are some areas that needs to be a bit more refined. And in fact, they might overdo it a bit because they get into even trying to regulate microly on the globally systemic institutions, be it banks, insurance, it's the same. And that triggers a lot of this prudential wave coming. You see the Basel III for the banking side is going to Basel IV in 2 years' time. And that also whiplash into the risk-based capital waves for the insurance sector. And it has spread even through the Asian countries. You can see the RBC is being like mushrooming amongst the ASEAN.
Risk-based capital.
Yes, risk-based capital, RBCs. And I presume captives are caught in the middle. It's like a tsunami of things. And that's only on the prudential front. We've also seen some scare in terms of terrorism and the rampancy of the money laundering. And that brings about all this greater scrutiny by the FATF. That's the agency for the money laundering, and where they assess really countries whether or not they really meet the mark in terms of the money laundering measures. And on the other front, the OECD, they look more on the economic development part across the G20 countries, the more major ones, and then also to the more dwarf economy, the developing markets. And they've seen some shift of resources across. So there's an agenda now to put a bit of stability in that sense, because things are going from the more affluent to the lesser ones, and of course to the offshore world as well. And captive also happened to be a more popular choice for offshore. So there's a bit of overlapping in those kind of things. And one would say that they are caught in the middle, captives. Saying that, I also see that the standard setting bodies like the IAIS, International Association of Insurance Supervisors, they take a recognition of how captive is operating vis-a-vis normal insurance and normal reinsurance. So they are not exactly the same, although they are the same breed, but different creatures. And to have a one-size-fits-all rule would be actually a disaster. And that's where they came out with a detailed application paper last 3 years, and mentioning the applicability of the core principles, starting from licensing, all the way to capital regulation, governance. There's a bit of differences in different types of captive. So between captive itself, there's a bit of a dilution of what regulator expects. In fact, between captives, different captives as well also need to be looked at before one rule can be applied. So pure captives versus diversified captive is entirely two different worlds. So that's where the risk-based regulation, I would say, not just capital, would try to fit the nice proportionate rule that fits that kind of captive circumstances.
I think that's the word I was hoping to hear, proportionate. That the level of regulation will be according to the amount of risk
To it, yes,
the captive delivers, yeah. Okay. Couple of questions here. Richard, you probably know more about this than most other people. The failures of captives. I seem to have been involved with a few of them in my lifetime, but they were never my fault. I know that you've done some investigation into this. What are your thoughts on failures?
Well, it's hard enough to get stories about successful captives, let alone get stories of failing captives. I would actually switch that. I might juggle out of this one, Malcolm. So I might switch this round and say the investigation that I've done, and I've discussed this with Malcolm, and Malcolm has a lot of experience with this, is when the parent fails. What happens to the captive then? And I would switch that around and say, yeah, there are lots of captive success stories, and there of course are some failures. However, what's really interesting is when the parent fails. So Enron's a great example in the US, the Enron scandal. That captive, the regulators in Vermont at the time put a ring around it and said, you're not coming and getting that capital because that we need this capital to pay future claims for whatever, long tail risks. I think one of the ones we were talking about was the Maxwell Media Group went bankrupt, and the captive was one of a few liquid parts of the business left. And then recently, who's the large government contractor?
Carillion.
Carillion have a captive, I understand, managed by Willis in Guernsey, and that's currently been but the captive is very well. But yeah, it's him. But I believe the captive, like I said with the other cases, is very well capitalised, and it's going through the usual liquidation process with, I think it's KPMG, the people involved. In terms of actual failures, then, of the captive, I definitely have written some stories about it. I'm struggling off the top of my head. Have you got any experiences?
I have an awful lot, actually. But I think my conclusion was that there was generally a weakness in the governance of the captive. The board wasn't operating properly, or it wasn't receiving the correct information, or the right decision-making process wasn't being followed. So when there was an external shock event, the captive actually wasn't in good shape to deal with it. And that's where the failure occurred. And I think, in terms of Syahrul talking about this increased regulation, actually what it's trying to do is improve the governance. It's trying to introduce better standards of operation. And it may be a bit of a pain at times, but actually it's a good investment in making sure the captive's being run properly, and therefore there's less chance of a failure coming out of that.
I think that when we talk about captive failures, I mean, the ones I remember were back mid-80s in Bermuda with a number of companies that had been writing third-party business. And if you remember, I started out in claims in Bermuda and spent a lot of time auditing the treaties that were ceding business, that were set up by the US insurers to cede business into captives to provide premium income to the captives so the captive could become a profit center for the parent organization. And it was true third-party business. And the captives were naive capacity. They were massively taken advantage of by the industry. And the classic example was a captive called Mentor, which had been set up by a US oil and gas company, Odoco, and the losses through the captive brought the parent company down. And that's one of the very few times that's happened. And that's why it's now very tightly controlled if you want a captive to write any form of third party. But it's where we do have clients in Labuan and in Singapore which are writing customer-related covers or employee benefit covers where the employees are effectively third parties, different entities than the parent, provided that firstly you're appropriately capitalized and the management structures and disciplines are in place to manage that, and the regulator's satisfied with that. And provided that the risk is actually a core risk of the parent's business and that the parent's interests are completely aligned with the customer's interests or the employee's interests. So the sort of horror stories of captives bringing down parent companies, that's the only one I can think of. And it arose from that issue of bringing in true third party, trying to make it a profit center without linking it to the core business. Yeah,
so it's almost acting as a commercial reinsurer. Yeah. Okay. So we've got a couple of questions here. One to do with market access and the difficulty of cross-border premium transactions. One of the things I'd picked up was this, I think, concern if the captives may be sort of imposing themselves on the insurance market. You know, are they competition for the local insurance market? So my general question to all of that really is there an optimum captive business model that works well in Asia? I mean, you can be a direct insurer, you can be a reinsurer, you can be a standalone captive, you can be a cell, you can be an association of several companies together. Does one size fit all, or is it going to be one of these answers that depends on the circumstances? So I don't know which one of the panelists wants to take that one.
Maybe I'll try it on a local scenery. I think it's all about awareness and understanding of what captive purpose and what it can serve the market as a whole. So at the end of the day, the main ultimate serving will be the risk owners, whoever has that risk. So be it through traditional insurance, be it on captive, at the end of the day, you want to guarantee that in the event of a particular mishap, there's something to hold on to. And the regulator's job is to make sure that those setup of arrangements are sound and it will meet its purpose in terms of providing that cover. Whether or not it actually cannibalizes or competes directly with direct insurance, it looks into whether or not the commercial market in the first place serves the product and fulfill the needs of the policyholders out there. If there aren't any, if there are abundance of such products and cover, I don't see the need for them to come actually to captives unless it's very pricey kind of arrangements. So to me, I would look at captive as a complementary to the whole market where they can't be supplied, then the locals or whoever, any policyholders in the market can actually turn to and do it as part of their risk management as well. And there's another part where you have your own risk management. Is one of those, something that even the central bank here, Bank Negara, promotes a sound risk management culture and to modernize them. So captive should be seen as one of the tools within the risk management context. So it's not as one by itself, a silo kind of thing. So earlier on, you were saying that how much is the price of setting up a captive or the premiums itself. I think it should be answered by the risk owner. If they felt that retaining the risk or trying to get the cover commercially doesn't worth the salt, then that's the amount that they're willing to spend for captive. I think that's where the local scenery should be in terms of raising awareness that captive supplements the market rather than trying to cannibalize and eat through the existing cake.
And I think historically we've seen that in other jurisdictions or regions where initially when captives were introduced there was a nervousness about working with the local market, but actually ultimately the market still retains the same amount of risk. They may be fronting it into the captive or they may still be picking up new lines of risk. So it hasn't affected the local market. George, any thoughts on sort of models for captives? Because, I mean, I assume that most of the captives in the region would be reinsurance captives, and you think probably it's the other way around. More of them are direct writers.
Well, I think the key point is that certainly in Singapore and Labuan, you're not either a direct writer or a reinsurer. You're a captive. So you can write direct, you can write reinsurance, you can write retro. And that gives you the flexibility to accept the business in the specific coverage, the specific policy, on the basis that makes most sense for that policy. There are obviously a lot of regulatory restrictions to deal with. For a Labuan captive writing Malaysian business, they can only do that as a reinsurer. But they can accept business from outside of Malaysia on a direct basis if that is allowed in the local jurisdiction. So in Singapore, half the captives are Aussie, and certainly the ones that we manage are all writing the Australian risks on a direct basis because you can do that. I think that's pretty common with Australian captives generally around the world. So it just depends. What you want with captive is flexibility. That's really what they're about. So the actual business structure of the captive needs to be as open and flexible as possible, and then you fit the particular program in as best suits that program.
And presumably you have a certain risk appetite, and if the risk is greater than that risk appetite, then you can use the market to take that.
Precisely, yeah.
Okay.
Yeah.
We've got a question here about the panel's thoughts on improving awareness of captive opportunities. I mean, Richard, you've done that sort of survey. Any sort of thoughts that come out of that?
Yeah, this was one of the key themes of the survey last year was that exact question really was, if one of the obstacles is lack of awareness, then obviously one of the solutions is going to be increasing awareness. So in terms of how we do that, I think that's not quite as easy an answer. I think, we're lucky today, obviously Labuan are hosting us today, and Labuan is definitely, as a jurisdiction, is making a lot of effort to educate, not just the Malaysian market, but the wider market through events such as this. Prima are big supporters of captive insurance. And I think the other area we see is, and this is kind of a softer, indirect contributor to increasing awareness, is just as Asian companies grow and mature, maybe they acquire Western or European or American companies, they might already have a captive. We particularly see that, I think, in China. The Chinese are often learning about captives through their acquisitions of large American corporates. So that's a more of a natural evolution. In terms of what we can all do, I think we're doing it today. And it's just how much more demand is there. It's not just about educating risk managers either. I think George might agree. It's probably also smaller independent brokers probably need to be educated about captives, not to be scared of captives maybe taking business away from them. I think that's a more delicate, maybe, relationship to engender. I'm not sure.
Well, quite a few of the brokers working in the big houses as well. So,
Yeah.
I mean, I had sort of 12 years out of captive running broking operations, and formed more captives when I was running the broking house than I do running a captive management shop, because the brokers are in with the client hopefully year round, but certainly spending a lot of time building up to renewals, assessing market conditions, and as I said earlier, putting more focus nowadays on understanding the risk profile of the client and how insurance fits that, and seeing where the gaps are. There is a tendency for them to think about captive as a potential answer for issues about 3 hours before renewal. So we're a bit short on time. So
That's why you need the captive on the shelf, then, isn't it?
Yeah, exactly. That's exactly the point. I mean, in the old days when there was actually a market cycle, and it wasn't just like that, there was a conundrum that, not conundrum, I don't know what the word is, but anyway, there were more captives formed in a soft market than in a hard market. And I think the reason for
Counterintuitive.
that was counterintuitive, that's the one. My grammar consultant. The issue was really that as the market turned, because in those days the market would turn generally quite suddenly, leading up to a particular renewal period, particularly in industries like energy. And the brokers were focused on trying to address that with the market and do their usual thing of alternately beating the underwriters up and taking them out for drinks to try and get the price down.
Yeah.
Then realised that's not going to work, so we need an alternative solution, and that 3 minutes before renewal, they come looking for captive. Client says, I don't want that to happen again, so over the course of the next year, the captive gets formed, and the market's turned again. So, you know, the need, part of this awareness raising exercise has to be, as Richard just said, so I've just spent 10 minutes repeating what Richard said, is getting the brokers to understand the role captive can play, and to help educate the client that it'll make our life a lot easier if we actually have this vehicle there ready to use to address any issues that come up.
Right, thank you. A really good question here just come in. It says, why are the regulators in every domicile, why are they encouraging captives? What are the benefits to the market, and presumably what are the benefits to the jurisdiction? So I think I know who I'm going to ask to answer that question. Syahrul.
Yeah, no brainer. Right, I think it depends on which domicile you're talking about. If the domicile itself offers captive, I think it's obvious that you need to sell that notion as well. But again, as mentioned, the regulator is there also to make sure that the insurance needs of the economy is somehow met in one way or the other, be it in the commercial market, or the most extreme, you do it yourself via captives. So that's why I believe that regulators should look at as one of the ways of its role to try to promote captive. It's part to fit in as part of the puzzle of the needs of the society in terms of insurance cover. What's the other one? I missed out the question. There was another follow-up question of that. What was it again?
So the question, it's gone, hasn't it?
It's gone.
But it's really,
Yeah.
what's in it for the jurisdiction, I suppose.
Right. And as I said, that's the first motivation. And second part is also part of developing both the private sector, the private corporate side as well, to modernize the way they do in managing their own day-to-day risk. So it's one of the agenda that Malaysia is also looking at. In fact, there was a forum under MARIM, a risk conference, where the central bank reminded that all CEOs should be CROs as well, because they need to manage it as part of the enterprise-wide risk management. And that shows and signals that you need to innovate beyond the usual. So yes, you have the commercial market for your insurance product and all that, but is it sufficient for your needs? Is there a way of which you, like mentioned by Oliver earlier, that can you opportunize for your own funds, managing your own funds within the group? So this is one way which captive can serve. And we look at that as one of modernizing the economy as a whole. So I think that's one of the direct benefits if a regulator also promote captive.
And presumably it's diversifying the economy.
Correct.
And it's a steady, regular
Yes.
revenue business.
Exactly. And it's a greenfield to Asia as well. It's not something that is rampant compared to the Europe side or the Caribbean side. So it's something very new, and that positivity should be nurtured. And awareness is one of the key things that was mentioned by many panelists, and I agree with that. And I think we shouldn't just we shouldn't just raise those awareness to just intermediaries and the commercial world, but also among peer regulators. You'd be surprised some of the knowledge gap that they have in terms of captives itself. Many of them still think that captive is just pure captives. Owner own, and that's it. So anything else are considered as anomalies or abuses. Very strange, but it happens.
Okay. Richard, you've probably got the most experience of European captives, and this is sort of bad news again, isn't it? And Solvency II was basically this new layer of regulation that was introduced, and it wasn't proportionate to captives. Captives were assessed the same way as a commercial reinsurer. What's been the outcome of that? I mean, you would think on the face of it, it's not good news.
It's interesting this question came in actually, and it feels like it was planted, but it wasn't. Because I've actually got on my phone some notes about this exact question. So when I saw
what a coincidence.
So when I saw it come in, I was like, actually, I've got some of that from the conference I spoke at in March. As you said, Solvency II is the European Union directive for regulating insurance, and that includes captives. There was an effort to exclude captives from that about, 10 years ago. Unfortunately, the associations involved failed, to be honest, to get captives to get captives excluded. Sorry, but I've actually got some numbers here in terms of the experience. I think the largest captives will say yes, cost has gone up. However, you mentioned before governance. They're starting to see now we're almost 3 years in some real benefits of the improved governance. They understand what the captive's role is a lot better when it comes to things like BEPS. Actually, a lot of the work has been done by being Solvency II compliant. However, I won't name them, but one of the largest telecommunication companies in Europe has a very large captive in Malta, potentially one of the largest captives in Europe. Writes a lot of third-party business, handset insurance, what was mentioned earlier, as well as its employee benefits insurance, its property, its global policies. Their risk manager told me last year that the cost of running a captive went up 150,000 euros a year from Solvency II. So that's quite a high cost. Another result we're seeing, we mentioned consolidation of captives before. It had been common, it still is quite common in Europe for large companies to have a reinsurance captive, maybe doing their global policies, and then a direct writing captive to write direct across Europe across various lines. So what we're seeing now is companies may move away from that strategy just to have one captive. So Carrefour, the French supermarket chain, they used to have a Dublin direct captive and a Luxembourg reinsurance captive. Last year they started running off their direct writing captive in Dublin. I think AXA had taken over basically the policies for that while they run it off. And we're also seeing, because of not just Solvency II, but also BEPS, we're starting to see captives change how they operate. So it's becoming, I've come up with this term called Mr. Substance. So what we used to see is everything for the captive was outsourced to Willis or to Aon, or other good captive managers are available. But now we're starting to see sometimes parent companies take the account manager from Aon. EDF is the example I'm thinking of right now. And they've got a Luxembourg and a Dublin captive, and someone from Aon is now working directly for the captive. He's employed by the captive, not by Aon, and he's got his own office separate from Aon, and he is the substance, and he's managing the captive. So that's obviously presumably an increased cost to EDF. So the experience has definitely been increasing costs. However, it's definitely complementing the kind of increased sophistication of captives in Europe. You're starting to see them diversify their portfolios more. Employee benefits is absolutely smashing it right now in Europe. We've seen so many more captives write employee benefits, and really the size of captives, although in Europe it's pretty stable, the number of captives, the size of them is increasing. So there's more premium going through captives as a result, I think, of Solvency II.
And presumably for the smaller companies, they're looking at a sell solution so they don't have to carry this regulatory burden.
Yeah, so obviously the cell, and I know Aon are talking about it in more detail tomorrow, but the cell is a more cost-efficient approach to captives. They still have to be Solvency II compliant, though. They're still insurance companies. And I think there's various approaches as to how cell companies are achieving Solvency II compliance. I think that's actually something brokers are still working on. The follow-up to that question was about, are we going to see captives move away from Europe into maybe other domiciles, such as Asian domiciles, such as Labuan and Singapore? I think, George, you've got some experience of European companies starting to look at using the Asian domiciles, but I presume that's not a result of EU regulation, or is it?
It's hard to say. I mean, it's a factor in play. I mean, one thing that we emphasise or we have emphasised with clients that have talked to us about moving to Singapore, for example, is that the regulatory environment in Singapore is fluid, as it is in all domiciles. So don't move away from a risk-based capital regime expecting the sort of flat solvency margin basis of Singapore to remain forever, because they've moved to risk-based on commercial insurance and reinsurance. We're not sure where they're going to move, because they don't tell you. You don't get any warning in Singapore unless they've been telling you guys, but they've not been telling us where the regulations are moving. But there's clearly a move towards a need for a captive, as any other insurance or reinsurance risk-taking entity, to be appropriately funded for the risk that it's taking, and to have the proper management procedures and personnel and direction and control in place to manage the risk they're taking. The issue, I think, with Solvency II that we hear from our European clients is that it's a very strong formula-based approach, and that formula very often produces illogical results. And so they're looking for domiciles where there's more flexibility, more logic applied. It's not just you bolt your numbers into this model and it says you need 100 million capital, whereas you can easily put a case that it should be 50. So that's led to some interest, and we have got some European formation activity going on, but the Solvency II issue is just one of a number of factors in play in that.
Okay. An interesting question here, the motivation to form a captive when you've got bad claim risk experience. I mean, I can understand when you've got good experience and you're thinking, well, the market's not recognising that and giving me a large enough discount on my premium. I suppose the other side is, if your risk is so bad, the market may not want to write it anyway. So,
exactly it.
And any thoughts on that in terms of examples of where having the captive has sort of introduced a higher level of risk management or risk awareness? To anyone?
I would think it's actually a consequence of having that bad claims experience. Nobody would accept you in the commercial world. So there's no product or service or product that can be offered that can actually meet the risk that the risk owner is providing for. So I think it's a natural consequence that you need to do something. And if you don't self-insure by just having your money in your deposit account, then perhaps you should do it through a captive where you manage and underwrite it professionally. So I think it's a consequence of.
Okay. The ideal time to set up a captive, we did this with a Hong Kong construction company with employee compensation risk, and they'd had, quite a few years ago, they'd had a really bad run. They'd killed lots of workers in very careless ways. So they'd had a really bad run. And the market basically had got fed up with it. The rates generally in the market had gone through the roof, and their premium increases were just massively punitive. So the key there was to address the core problem, the source of the problem, which was the very poor risk management procedures, and to work with them to address that, to manage that, and then to take the risk out of the market for a while. So you can reinsure a licensed admitted fronting company in Hong Kong for ECI, which we did actually into a cell, and then put an ag stop reinsurance around that with the reinsurance market. But the vast majority of risk was held by the client. And over the course of the next 5 or 6 years, the client, with our support, brought that loss experience down dramatically And those savings were all generated through into the captive, or the cell in that case. So that's your ideal timing, but it doesn't always work that way. Sometimes you set the captive up and it keeps getting worse. But
Yeah. Well, the first law of captives is, isn't it, that as soon as you set it up, you have a really bad year experience of losses.
pretty much how it
Yeah.
works.
So, Richard, any thoughts on this?
Yeah, I'll take that a step further, actually. So a really good example of a really bad claims experience prompting a change of approach is the New York metro system. So the subway, New York Metropolitan Transport Authority, is what runs the transport for better or worse in New York, and they have a captive, which is a New York domicile captive. And after Hurricane Sandy, they had a huge storm surge, flooded the subway, and they made a full reinsurance claim to the market. And when it came to renewing that at the end of the year, the reinsurance market told them to get stuffed. So they already had a captive, but what they did is they went a step further and they sponsored a catastrophe bond in Bermuda using their captive, and that was $350 million catastrophe bond over 3 years, and they've since renewed that again because they had a good return on that. So we've seen that. That's a good example of where they've had to react. It wasn't a captive; it was an alternative risk transfer mechanism. They had to react to a bad claims experience and go a different way. As a result of those bad claims, and the reinsurance market, the commercial market, wanting to have nothing to do with them.
Okay. So basically you're saying that there's no good or bad time for setting up a captive. It's just if the strategic reasons make sense. Okay. We've got a question on substance, which I'm going to avoid because I think that's going to be handled by some other panelists later on, although I think I can say I provide a fair amount of substance to this panel discussion. There's a question here about the role that reinsurers play in self-insurance approach, which seems to be slightly funny. You know, on the one hand, you're talking about self-insurance, and then you're talking about, well, can the market help? But I think my experience is that when a lot of organizations decide to formalize their self-insurance in a captive, they have a modest risk appetite. They don't want to allocate a lot of premium, and they don't want to take a lot of risk. So there are a lot of reinsurance partners who are very happy to work with a captive and take a substantial amount of the risk in the early years. If the experience is good and the captive builds up profits and that increases their capacity to take more risk, then the reinsurers are often very happy to reduce their involvement gradually over time as the captive becomes stronger. So that's a very good sort of partnership arrangement. And I know that, for example, Swiss Re do a very good product, but certainly the other players, XL, Zurich, they all work very closely with the captives and will help them sort of grow and develop into more successful vehicles. Any thoughts from the panel on working with an insurance or a reinsurance partner?
I mean, it's a win-win for the reinsurers or the insurance companies that act as reinsurers of captives, which you see quite a lot. It's not necessarily specialist reinsurers providing the capacity behind the captive. Because a client who's set up a captive has taken a very well-informed and well-studied and reviewed step to formalising their management of their risk and their management of their retained risk. And that indicates a sophisticated buyer, somebody who's taking risk management and risk mitigation seriously. And that's going to reflect through in the quality of the risk that's going through into the reinsurer. The reinsurer then is in direct contractual partnership with the captive, which is owned by the parent, which is the company which controls the risk. So it's a symbiotic relationship. It works very well, and that's long established. It's probably the original driver of the captive industry, I think, is that direct relationship with the reinsurers.
Okay.
Yeah, I mean, there's also experience in Malaysia as well, where the cover for certain risks, like for example, marine, for the lower tonnage vessels, there isn't a taker in the local scenery market. So what was done was that the so-called club of indemnity, they actually had a partnership with outside reinsurers to get that capacity, because there's none in the local scenery. So likewise, if you have that kind of analogy imposed on captives, captives can actually expand their capacity and even be able to access to the reinsurance market just by having it as a dedicated vehicle. Otherwise, if it's actually meant as a self-insurance, I don't think risk owners can easily just get that kind of cover from reinsurance because they're not rated in the first place. So it's one way in which reinsurers can sort of like facilitate the growth of captive by supporting that capacity and even technical expertise. And I also saw some parts, question pertaining to the Malaysian captives where they are restricted to traditional insurance underwriting. And I think that's where I believe that even reinsurers can play a role. The lack of experience for Malaysian captives, I think, is the one that makes them resort to normal traditional risk transfer, like reinsurance. So you want them to try out something sassy and a bit more, contemporary, ARTs, ILS, and whatnot. I believe they need professional, technical specialists out there, which easily can be found in reinsurance world. And this is where they can actually help to evolve that so-called simple captive into a bit more complex and
so
dedicated.
they can provide their technical resources.
Correct, exactly.
Okay. Well, I notice we're just about out of time, and the MC is standing up, so that's obviously a hint. If I can just conclude, and I'm sorry we didn't manage to get to all the questions that the audience raised. If I conclude, this intersection between industry and the regulator has a certain amount of tension there, and I think that's been the case for as long as I can remember. I think I would say that tension is probably healthy. On the one hand, the industry is pushing for change and they want to come up with innovation, and then on the other hand, we've got the regulator really who's there to make sure that best practice is being followed and wants to ensure the solvency and the security of the business. So to me, it's a win-win, although at times it can feel a little difficult. So with that conclusion, I'd like to thank the panelists and thank you very much for your participation.
Ladies and gentlemen, big round of applause for the moderator and members of the panel.